I'm Craig Torres, and this is the Global Rewire podcast. I'm here with my co-host, Fabio Nattalucci. And today we have a guest from the South. He is Guy Debelle, former Deputy Governor of the Reserve Bank of Australia and current board chair at Funds SA, a public pension fund, and a board member of Taiwan. He's also on the board of the Australian Retirement Trust, the second largest pension fund in the country. Fabio, I'm going to let you take this away.
First of all, thank you very much, Guy, to agree to join the podcast. Guy and I have been talking for many years since the GFC, and he can provide a very useful perspective from a different part of the globe. In particular, we had a couple of podcasts where we are discussing these geoeconomics topics, right? So we did it from the US with Matteo Maggiore, we did it with Logan Wright from taking the Chinese perspective, and then we did with David and Sarah talking about the Europeans, how Europeans see it. So I'd be curious to see from that part of the world, how does geoeconomics looks like in the geopolitical tensions?
Yeah, no, thanks, Fabio, and thanks very much to you and Craig for having me here. Yeah, Australia does sit in a somewhat unique position in the current geopolitical environment or geoeconomic environment. China is comfortably our largest trading partner. We sell them most famously and mostly a lot of iron ore, which they then turn around into making into steel. So Australia is the largest provider of iron ore into China, but it's a very large chunk of our export income. So with China as our major trading partner, US at least for the past 70 odd years or so, our major strategic partner, we sit in an interesting and sometimes quite uncomfortable position straddling the two of those. And, relationships have waxed and waned even over the last 5 or 6 years. Sometimes China likes to use Australia as an example of to the rest of the world as to how things could go badly if you don't go along with what they're saying. But then at the same time, the US likes to make sure that we're absolutely alongside them, which historically, as said, post World War II, certainly we have been. So, yeah, it's an interesting position that we straddle here in Australia. The one point I think, which is also a useful way to think about it, is the shadow price of the relationship between Australia and China is iron ore. So when we were persona non grata with the Chinese, sort of post-COVID, when our then Prime Minister suggested it'd be a good idea if there was a investigation into the source of COVID, which didn't go down that well in China. They basically cut off all of our exports except iron ore because they realized that they needed that at least as much as we needed to sell that to them. So, the relationship has waxed and waned. It's currently in a reasonable position, I would say, but it's an interesting lens into the geopolitical tensions.
Can I follow up on this iron ore topic? Like there was press report that one of the largest firms back down in Australia, BHP, were going to start settling 30% of their spot iron ore sales to China in renminbi. I remember this was a discussion that's going on for a long time, but I understand this is the first time they actually agreed to do that. Can you tell us how that settlement in currencies play into geoeconomic tensions? Whether do you think this is the direction of the future between Australia and China? It was a very interesting development.
Yeah, I mean that's been a thing for I would say getting on almost for 15 years now. The Chinese have been, as you know, trying to encourage the renminbiization certainly of this part of the world, of Asia. When I was at the Reserve Bank, we signed a swap agreement with the People's Bank of China, which is still in place today. And that the motivation, at least at the time, was to facilitate trade finance and to encourage greater use of RMB by Australian exporters into China. A company which I worked at a little bit for a couple of years after I left the Reserve Bank, Fortescue, which is the third largest iron ore producer, did have some trade that they did in RMB. So the Chinese would say they'd give you a better price if you bought it in RMB than if you did it in US dollars, which is what traditionally, like most commodities, it's denominated in. Fortescue did a little bit of that, but only a little bit. And so it's interesting that China are trying to get BHP to do that. from a financial point of view, the pipes are actually work pretty well now, so it's not necessarily that big a deal. The iron ore producers generally don't hedge much. Fortescue certainly didn't hedge much at all. They buy spot. They don't hedge the FX risk on their sales that much either. So the absence of a deep derivative market is not necessarily that much of a constraint for those guys. So, it's really a political gesture as much as anything. But I said up until recently, there really hadn't been much trade flow between Australia and China, notwithstanding how large it is, that has been denominated in RMB. So it'll be interesting to see how they go. But generally, the Chinese throw in a bit of a price incentive to encourage you to do it in RMB rather than in USD.
Guy, is that just symbolic? Because from what I read, China isn't about to open its capital markets to a lot of investment, banking, et cetera. So why would they want to do this?
I mean, it is really to just develop alternative financial rails to the US dollar. And then that's been going on to varying degrees right throughout East Asia down into Australia I would say since about 2010 or so, somewhere around there. That's been happening more. But it really is to try and develop an alternative set of payments rails to the US dollar so that if and when sanctions are ever applied, then they have an alternative payment channels, I would guess.
So I know Fabio has a dollar hedging question, but I'm going to set it up like this. So we've seen the U.S. Retract from its role providing a large security umbrella to Western democracies, and under that umbrella having sort of favored trading relationships with those democracies. Now we're putting tariffs against these nations. And the question is, it's a question we're asking at the Institute. Can you have economic fragmentation and financial integration?
I mean, I think potentially you can, because there are many different channels that you can get goods from one country to another. And we've seen that occur as various blockages have been put in the system over the last few years. I mean, it hasn't been so much of a challenge here in Australia. I mean, one interesting thing from Australia, we are one of the few countries which run a current account deficit with the US. So the US actually runs a current account surplus with Australia. So we are one of the very few in the world. That didn't stop us getting a 10% tariff put on it, but we don't sell so much to the US, so it affects a few industries, but not a lot. So we sit slightly in a different part of the system from other countries in terms of our relationship with the US. But I think the financial flows and the economics are separable. The trade flows are separable. And then as much as the Chinese are trying to put pressure on to try and shift stuff towards RMB, as I said, to date, they just really haven't been that successful. So notwithstanding large increase in trade flows with other parts of East Asia, they're still predominantly denominated in US dollars. So I do think you can have still economic fragmentation, but still that overlay of the financial flow still going through the same piece of plumbing. Because in the end, I think what the US dollar's great advantage these days is it's literally hardwired into the financial system. So much of the financial system is, the amount of literal reprogramming you'd have to do to get the US dollar out of the system or to have an alternative set of rails is a hell of a lot of work. To my mind, that's its biggest advantage these days, is just this huge amount of infrastructure that is built up around the US dollar. And so as much as you might have economic fragmentation, those financial pipes are very hard to replicate, as any number of countries have found out.
Can I follow up on this train, taking maybe a slightly different angle? So do you talk about ramification of the system or the swap lines that the PBOC has with a number of countries, including not just Asia, right? There's also the ECB, for example, and others. So there seems to be going down the CBDC route. The US has taken a very different approach, which is essentially there's a prohibition in the Genius Act for the Federal Reserve to issue CBDCs. Dollar stablecoin, that's one way to look at this, is trying to expand the dominance of the dollar in the payment system and then building digital finance on top of it. How do you see those two different approaches, right? Central bank driven, private sector driven, kind of fighting for dominance in global financial markets?
I think the cross-border payment flows, as you know, have always been the biggest challenge. And so I do see, so here at the Reserve Bank of Australia, where I used to work up until a few years ago, the focus has really been on cross-border flows and sort of tokenization solutions around that. I don't think we need a stable coin in Australia because we have a very good payment system, unlike the crap one in the US.
That's a technical term.
Technical term, yeah. And so there isn't a need for that, but tokenization is where there's a lot of focus here, and particularly around cross-border payments. Interestingly, not just in terms of large payment flows, but the other big challenge in this part of the world, there's a slight diversion, but is around the Pacific Islands, who are being debanked basically because of money laundering standards. And so therefore, they need a cross-border payment solution, and so tokenization is potentially a solution for them. So the focus here in Australia and with other countries in this part of the world is really on those cross-border settlement flows, and perfectly fine if they happen to be in US dollars, but it's really, but hopefully it's more a domestic currency to domestic currency issue. But then, as you say, you need those linkages between the central banks to facilitate that.
The way I look at this, though, for me, like stable coins are just like the first building blocks, right? Of all this tokenized finance that is coming. Like it was just on the news today, like, I don't know, JP Morgan is going to start issuing a tokenized deposits on the public blockchain. Then you have Visa is going to start announce that they will use USDC, so the Circle stablecoin, for actually business payment. So it's starting to build into the general ecosystem of finance, and tokenized equities, those are the next steps, right? So I think looking just as a payment system at this point risk like looking backward as opposed to looking forward where finance is going.
So stablecoin as a sort of money market fund instrument is okay. I get why you might have that in the US, but I don't find that at all relevant here. It's really the tokenization for real-time settlement, and including actually, there's quite a lot of work going on in Australia around settling in commodity markets, for example. So you can tie the payment to the commodity. So I really see it as a moving to sort of T+0 settlement across any number of financial claims, including real economy claims as well as financial claims. So that's where I see it, and so I don't see stable coins as necessarily being, okay, that's a part of that technological development, but I don't actually see it being a critical part. Is the tokenization part, which I find is probably the most relevant part going forward, and where a lot of the focus is.
Who's leading that in Australia, Guy? Because here you kind of have fintechs, which are kind of position themselves as the great non-banks that are the innovators. So are banks involved in tokenization, or is it non-bank fintechs, or who?
So I would say non-bank fintechs, the Reserve Bank sort of is involved in that. There's and integrated with academia as well. So it's the digital finance research community, which does a lot of work in that. So it pulls together fintechs, the banks, the Reserve Bank. So the whole financial system is sort of interested in moving that forward here. I mean, as I said, partly because it's building on the payment rails that we have here, which the Reserve Bank sort of put in place, getting on to almost 10 years ago, which is a really good real-time payment system certainly for all, it's instantaneous value for basically all retail payments. And then it's moving that into the wholesale space. So the banks play on that, have the main participants in that, but any non-bank can come in and sit on top of those payment rails. So it's actually the whole system moving that forward here rather than, one or other part of it.
I wanted to ask you a question on Now you're talking about the dollar. There was a lot of discussion back in the spring and early in the summer about U.S. exceptionalism, whether it was fading, not fading, what the dollar exchange rate was doing. It dropped and then it kind of moved sideways. What's your take on the U.S. exceptionalism, and lots of discussion on whether people are doing FX hedging, and maybe this is why, despite equity inflows into the U.S., the dollar doesn't really move other than sideways?
Australian pension fund. So just to give you some context here, the Australian pension system is the third largest in absolute size in the world. So it's big. A large chunk of that is invested in the US. So a large chunk is about 60-70% is invested offshore, and a very large chunk of that is invested in the US. So there are a lot of US dollar assets held in the Australian pension system. But in the end, the pensioners are going to be consuming in Australian dollars, and so that's what they want in the end. Historically, the way it worked was all the fixed income flows were hedged back into Aussie, and very little of equity or real assets were hedged back. Now, the separation of sort of FX exposure, for a while now, FX exposure has been separated from the underlying asset. So you look at the hedging from the whole of the book rather than asset by asset. And so the way I think about the possible decline of US exceptionalism is I break it up across the asset classes. So I look at equities and say, okay, I can have a different view on US equities than I do on treasuries, than I do on US fixed income, public credit, than I do on the dollar. And so I can still be quite happy to see exceptionalism in US equities and buy into that. But then I'm concerned about the direction of the dollar, and so I hedge more of that than I used to. And I would say that was absolutely the dynamic through post-April, and for a number of months after that was hedge ratios went up. People weren't selling down the US equity stakes necessarily, but they were just hedging more of it. And so you can have that, US equity market can still continue on its merry way. I can still really like that. But in the end, my pensioners are consuming in Australian dollars, and they care about what the Australian dollar return on that is rather than the US dollar return. And so I can hedge against hedge more against the US dollar to protect against that. So I would say, yep, absolutely. That was a dynamic for a number of months post April 1st. It does seem to have backed off a bit in the last couple of months, but I don't think that thought process is behind us yet. And as I said, I can completely separate my view on the equity market from my view on the dollar and how, in terms of how I want to protect myself financially. And I certainly think that a number of the funds I'm involved with, that's absolutely the way we think about it, is we separate out the assets, and FX is another asset in the portfolio rather than, just a, transactions medium.
You didn't use the word diversify, which is certainly what's happening in some places where people are buying gold or something else.
So the question you always have to ask, if you want to decrease your US dollar exposure, is like, okay, so what am I buying? So where am I switching into? I think here it's easier if I look at it from an Aussie point of view, I'm more comforted that in a lot of scenarios I see, more upside to the Aussie US exchange rate, i.e. the Aussie dollar appreciating, than downside. So I can feel more comfortable about taking it, hedging more of the book. It also partly comes down to cost. It's more or less costly to hedge in some currencies than it is in others. When I say hedge, also, we're not talking, at least in the way the Australian pensions funds work, this is not hedging out over a 5-year horizon. This is hedging out over mostly up into a 12-month horizon, because it basically gets too expensive beyond that. And so what you're doing is spreading your hedges out across that 12-month horizon and maybe just increasing them a bit as you roll.
Essentially, just roll them, right?
Yeah, and roll them and maybe add a bit as you're rolling. And so that's why it's a slow burn. It's not you don't see a massive shift, or at least the way the Aussie pension funds do this. I think is roughly true of others. But I said, you have to think about, what am I hedging into? So in our case, we can just increase the hedge back into Aussie rather than necessarily saying, okay, I'm going to hedge more into euro or hedge more into yen or whatever. So you have to think about what it is that I'm switching out of the US. And so, and coming from the asset point of view, it's like, okay, I want to diversify away from US equities, so I can decrease the premium of attached to US exceptionalism. So I can make that less. Who else is going to deliver me that sort of absolute return? Which other part of the world? That's the question I have to ask. And and if I look at that in the current environment, at least, US exceptionalism as embodied in the equity market still looks pretty strong, I would say, and obviously concentrated in a reasonably small area, but I can at least rationalize why that still looks a good investment.
Is that there is no alternative argument, essentially, right?
Yeah. I have to invest somewhere. That's the bottom line. I'm not going, probably particularly in the current environment, not shifting a whole lot of stuff into cash.
So, Fabio, this is a good moment to ask Guy about AI. So, sitting in the US, Guy, boy, is a market obsessed with this. And it's, I'm writing a piece that, people are exiting property REIT stocks at a time when absorption rates are increasing because they fear this white collar job apocalypse is going to be real, which, and it just looks way oversold. Staffing companies are down for the same reason. Um, Somebody told me yesterday the investment account of GDP is adding topped consumption in the last quarter. I'm going to have to go look at that. I don't know. But so, how do you see this as someone who isn't here but kind of has to invest here?
So I think there's a few different ways to look at it. One analogy I think is worth thinking about. If I add up the investment of the Magnificent Seven and look at that as a share of the US economy, it's not dissimilar to what we experienced here in the early 2010s in Australia when we had this huge resource boom and the three large mining companies just went on a massive investment boom. To some extent, it made our life easier as a forecaster with the Reserve Bank of Australia for investment. At least we just had to ring up, make 3 phone calls, and we knew what investment was going to be over the next 12 months. And so that was nice from a forecasting point of view. But it's not dissimilar today in the US. You got 7 phone calls to make, and you've got a pretty good handle what the investment looks like. It counts for more than all of the growth in CapEx in the US at the moment with, I think, basically with those 7 companies. So that's the sort of macro lens. I find it interesting from the financial lens. What slightly concerns me is it's been, up until now, on basically almost literally today, it's all been cash financed, right? So they've been able to fund it all off their own balance sheets. And so I can look at it in terms of what do I think their internal rate of return on that investment is. Can I see how they're going to recoup those gains in the future, which I think is an interesting question. It's like, who benefits in the end? Is it which part of the ecosystem is going to benefit? But so I can have my view, my lens on that. What I'm slightly more concerned about is these sort of deals which look a little more circular between some of these companies, and the fact that we're now throwing leverage onto the mix, because leverage is always increased leverage is often a sign that something like, leverage in the right place, obviously a good thing to do, but I get more concerned the more leverage I see coming into this space, and particularly with these, as I said, these sort of, I would say roughly circular financing deals between some of the big participants. And I don't know, that slightly concerns me from an investing point of view. But really from the investing lens, what we're trying to think about is, well, who's in the end going to reap the gains? And it's not necessarily, what part of the infrastructure is not clear, who's going to be reaping those gains, which part in terms of the final sales to the consumer, who's going to be reaping the gain from that. And so that's really the challenging question to ask. Is it going to be, the railway companies back in the US weren't the ones in the end who made all the money. It was the people who were using the rails which made the money. Partly there was a bit of an antitrust lens thrown over the top of that, obviously, but I think that's the interesting question to ask. At the moment, we're looking at all the people mostly who are using the rails, building the rails. And the question is, who are going to be the people using the rails? Just finally, on your employment thing, I mean, history tells us that when top technological change comes along like this, there's always these fears about everyone's going to lose their job. And then here we are today, sitting here in 2025, and basically we're at full employment, in most parts of the world. So now maybe this is the one where that's not true. And if I were in particular professions, I'd be worried. If I'm a consultant, I'd be a little more worried than I have been for a while, that some of my skill set might be displaced by AI. If I'm a junior investment bank analyst, I might be worried that that job isn't looking so good, or if I'm a law clerk or something like that. But, that what history generally has demonstrated, or not generally, universally has demonstrated, is there's going to be a whole bunch of other jobs which we don't even know about today, which are going to come along and replace that. Now, maybe this is the final singularity where that isn't true, but I remain skeptical right up until the point that it's very clear that I'm very clearly wrong.
Can I go back to the AI bubble question that Greg asked? And I completely agree with you. I'm going to add two different twists to the same argument. I think on the debt, it's not just the amount of debt that is being added, right? So September saw a huge amount of, for example, investment bonds issuance. Some of it now, it's in the private credit sphere, and using structure that are reminiscent of period that were problematic, like SPVs, off balance sheet. That stuff didn't end up well during the GFC. So it's not just the total, it's the composition of that, I think, and the structure of that. And then on the circularity, I don't particularly like this word. The circularity seems like it's more like it's concentric, right? There is one company in the middle that committed for more than $1 trillion of deals, which $20 billion revenues, no profit so far. So it's a systemic of this concentric structure that to me is more concerning. I don't know if you agree or not.
I agree. It's the company sitting in the middle of that. I'm possibly, less worried if I'm NVIDIA, because, they've got a lot of sales and they've got a lot of revenue. But the company OpenAI sitting there in the middle, not obviously going to be the massive revenue generator in the future. So that's what concerns me. I don't share the fact that it's private versus public credit. I don't see as a material distinction, in the sense that I am reasonably ambivalent as to where the credit comes from, whether it's from the bank. As long as someone's doing the right due diligence, I'm not so fussed as to whether they're sitting in private credit or public credit. I mean, as we know from 2008, banks is just as good as bad at writing bad loans as non-banks. So it really comes down to the quality of the due diligence rather than the source of the lending, I think.
It was not a statement on public versus private. It's more a statement, I think, on the type of structure that are being funded.
Yeah. In the end, if it's a straight loan to a company with a revenue, a standard loan, I think if you think about what they're looking for here, that should suffice. If they've really got that revenue growth ahead of them, a bog standard loan should absolutely work for them. They don't need a particularly, fancily structured piece of credit.
This raises, Fabio, the question of energy. Guy, so we seem to be slamming the door shut on renewables. It's kind of astonishing.
You mean, when we say we mean in the U.S.?
Yeah, the U.S. policymakers. And it's interesting to watch the response. This is one area where leaders are not following Trump at all, and they're going forward. So can you talk a little bit about energy as it configures international competition? I think that's the way to ask the question.
So one of the other cats I have, which we didn't mention at the beginning, I'm on the board of the Clean Energy Finance Corporation, which is the Australian government's green bank. So we lend directly into the energy transition and invest, actually, both equity and debt, into the energy transition here. So have a direct lens on that. And Australia's historically, for better part of 50 years now, been an energy exporter, quite a large energy exporter, particularly into East Asia, primarily coal, but also, and then for the last 20 odd years, natural gas. So now we're looking at the opportunity of exporting green electrons, because Australia is also well endowed with fantastic sun. I know that's the sort of story most people associate with Australia, but it turns out we have high quality sun as well, and high quality wind, and often high quality sun and wind in the same place. And as we're also famous for, we have quite a lot of land to put this stuff on. So we have comparative advantage in renewable energy. And then if we think about, we're also obviously well endowed with a lot of minerals, both the critical minerals which go into the supply chain on the renewable side, but also I think about something like iron ore. We have the capacity to make green iron, because combining the iron ore with the renewables. So, and export the green electron to the rest of the world in that form. So clean energy is a central plank of both the federal government and a number of state governments' strategies here. So we are fairly well advanced along a energy transition here, with a number of hiccups which are similar to those experienced elsewhere in the world, but we're still moving forward at a reasonable pace. But just to give you some context, in my home state of South Australia, they are looking to be net 100% renewables by 2027, by end of 2 years' time. And they are well on track for that. So when I say net, there will be days where they need to use some gas to firm the system, but by and large, there'll be 100% renewables. This past 12 months, they had 180 days where the state ran on renewables only. So, we're reasonably well advanced in that. But we use the government definitely sees energy and clean energy as a massive, both absolute and comparative advantage for the Australian economy.
Sorry, one quick question here. And this has moved along because the storage technology has improved too, right?
The government introduced a household battery subsidy scheme on the 1st of July. Storage at the household level has just gone insane over the past 4 months. So it's something, literally thousands of household batteries being installed per day. So storage. So if you think about the cost curves going back 10, 15 years ago, the cost curve of solar really started coming down. And so we have a lot of rooftop solar here in Australia. Then the cost curve of wind started coming down. That's not been quite so linear, and there have been a few ups as well as downs along that. But now storage costs are following that same decline in the cost curve that we saw with solar 10, 15 years ago. So we are seeing both at the micro and the macro level a lot of storage solutions being implemented now. So the main projects you see in Australia now are generally combined solar storage projects. So you won't do a standalone solar farm and put that into the grid. You'll do solar and battery, because we have a very large chunk of the day here in the middle of the day where you're looking at negative prices. So you need storage to make the economics work. So that you're not exporting the power as soon as you're generating it, you're exporting it later in the day when the price is, much more attractive.
Can you share with us how an entire nation got on board with this?
Subsidies help, obviously, but this is one where, it does help that the sun does shine here a lot, right? So it's not a hard sell to people. I mean, if I was in northern Scotland, I'd have probably a harder time selling this one, right? But also people worked out that, and the government made it clear, and other agencies made it clear, that the economics actually work. So the payback time for households in terms of installing solar, and particularly now batteries, it's only a few years. So yes, there's an upfront investment, and the government subsidies help with that upfront investment, but it's actually not that hard to get across to people that the payback time is actually pretty quick, particularly given the rise in energy prices we've seen, post the Russian invasion of Ukraine. So I said the hip pocket economics actually work fairly effectively. I mean, I don't want to say it like it's all sweetness and light here, in the sense that the largest scale. So rooftop or household solar and battery is very popular. Large-scale generation projects in rural Australia get a lot more opposition, actually, and particularly, ironically, transmission as much as generation. So people really don't like seeing transmission lines going across their farm. So that's been quite a challenge in terms of deployment over the last few years. But at the micro level, huge uptake, a slower and more problematic uptake at the sort of macro level, ironically.
From a macro perspective, I remember when I was at the fund and I was covering climate finance, I looked into this company, Cable Sun.
Sun
There
Cable,
was some of the narrative, Sun Cable. And some of the narrative was that once the grid was in place and the battery technology improved, they would actually be able to export as a country energy, renewable energy to Southeast Asia. Is that something that's happening?
So yeah, Sun Cable is an interesting story. So I mean, they're still going. So they're generating a whole bunch of solar energy roughly in the middle of Australia. So in Northern Territory, but not far. Just think about it being from the middle of Australia. They then string a cable from Northern Australia up to Darwin, which is on the top of Australia. It's only a few hundred kilometers, or it's only 100 kilometers or so from Darwin to Indonesia, and then not too far to Singapore on the other side. So Sun Cable's original proposition was to string a cable from Darwin to Singapore. They've pivoted a bit on that now, and they're looking more at, okay, do I want to look at generating those electrons and then, apropos data centers, install a data center in Northern Australia and export that? If I don't care about latency so much, and there are data centers where that's fine, then string a fiber optic cable to Singapore rather than a transmission cable. So the question is, how do you export that green? What's the medium I'm going to export that green electron? Australia comfortably can end up with a very large surplus of green electrons. We have more than enough capacity, but we need the end demand, obviously, to get to that point, and we need to work out how we're going to export that green electron to the rest of the world, probably in a way which doesn't involve stringing a very long transmission cable to the rest of the world. So what form, be it in a green mineral, be it fiber optic in terms of data center or whatever. So the question is, what's the medium we're going to export that electron through rather than a big cable?
Maybe I'm going to close with a monetary policy question. Inflation's kind of sticky in Australia. It's sticky in the United States. It's it's for different reasons, I'm sure, and some similar reasons.
I think it's actually roughly the
Same
same.
reason,
But
okay.
yeah.
And so, central banks have inflation targets. In the U.S., we've been above that target for 4 years. So what's the call here, Guy? Just to be patient or to go after it, and be a little bit more aggressive?
I'll look mostly through the lens of the US, so I don't do some Monday morning quarterbacking on my former colleagues here at Australia. But you can decide whether you want to draw an analogy from one to the other. But I mean, I look at the US situation, and I do think, yeah, it's sticky and also persistent. I mean, I think we're now, we had that really benign period from 2007 to 2020. Partly with the integration of the deflationary shock of integrating China into the economy. We're not replicating that one again. The big question mark on future deflationary shocks really is around AI and the potential productivity benefit of that. But if I was a central bank, that's probably outside my policy horizon anyway, until I see very clear signs of that. So I'm not saying that may not happen, but I'm not saying that's happening. I don't think that's happening over the policy horizon. So I don't see too many deflationary or disinflationary shocks out there the way that I used to. And instead, I feel, I would say we're back in a more inflationary mindset. I don't like, not so much, yes, I can look at inflation expectations and try and, get a direct handle on that. But I think more from a mindset point of view, we had a whole nearly 20 years of a disinflationary mindset, and companies really didn't think about putting up their prices that much. And then we had 2022, and everyone suddenly worked out that there are circumstances where I can put up my prices again, particularly if all my competitors are facing the same cost shock and they're doing that. So I do feel we've moved to a much more inflationary mindset again. And so if I'm a central bank and I'm sitting there with inflation at 3, I don't really see where that last mile of getting 3 down to 2 is coming from, to be honest. And so, I mean, obviously a recession can do that for you, but I also generally probably want to avoid that. But at the same time, I would be concerned sitting there saying inflation's at 3, we've got an inflationary mindset. That doesn't mean inflation's moving a lot higher anytime soon, but it ain't moving lower. And so and then if I look at financial conditions, particularly in the US, they look pretty expansionary to me. And so if I put all of that together, and I get that, well, who knows where the unemployment rate is at the moment, but it's always useful if you don't have any data.
Eventually we'll get some data back that we can look at.
Yeah, and hopefully it's not until you see everyone, once you see a whole bunch more people on the streets, that's probably a bit too late from a monetary point of view. So you don't want to wait for that data observation. But yeah, so I get that the labor market may have softened a bit, but I still, as I said, I'm looking, if I was, I'd be more saying, well, actually that's part of the disinflationary impulse I need to get inflation back to 2. So in that world, I'm really struggling how I come up with a decision to lower interest rates, to be honest. Because I said financial conditions expansionary, inflation already is at 3. The economy doesn't look all that soft given the huge investment boom going on at the moment. So in other times, that would not have been the conjuncture of events which led you to decide to ease policy, let me put it that way. So I'm struggling to see really what the motivation for that is. And if anything, I'd be more worried about inflation isn't coming any lower. It's, if anything, probably going to edge, it's moving up more as much as likely as it is moving lower from here.
I would say there was a chart on one of the investment funds today that I looked at that was showing that more than 50% of CPI components are above 3%, for example, and moving higher.
Yeah, that's what I mean about the inflationary mindset's there, and it's widespread across the economy because everyone, got reminded in a very short period of time in 2022, 21, 22, just how inflationary things can actually be, having basically forgotten about it for most of the previous 20 years.
I cannot, now that we go into monetary policy, you talk about AI and productivity, I need to ask you about R-star. Where is your long-run R-star if you are in the US?
I love the Vixelian framework, but unlike Job Williams, I am not obsessed about R-star. And so, I've said that directly any number of times. But my view of the world is I look at where financial conditions are in terms of a whole bunch of prices. I look at what the outcomes of that are. So, what is credit growth actually doing at the moment, be it public or private? That gives me what's actually happening in the economy. And then if I want to reverse engineer that back to a particular number in my economic model, fine, that's nice. But from a policy point of view, I much rather look at what is actually happening with the data. And then that tells me whether policy is expansionary or contractionary. And I'm not that fussed about, once I get in the general vicinity of whatever neutral is, I'm not really that fussed about what exactly the precise number is. So I much more rather look at what's going on at the moment, what's happening across all those different dimensions I just mentioned. That tells me the stance of policy rather than a number with a star, a letter with a star attached to it.
So I'm assuming based on this statement that this is not the right time to deregulate financial market, given where financial conditions are?
No, I mean, the only thing I do think from, I understand, the SLR, I can understand that and separate that from other aspects of deregulation. I can see maybe a little more motivation for that in terms of sort of smooth functioning of the treasury market. But beyond that, no.
Thanks for joining us.
Thanks, Craig. Thanks, Fabio. Great to talk.